The Strait of Hormuz has not closed, but the 30-year Treasury yield already crossed 5.1%, a level not seen since 2007, and that move matters more than the oil price itself. Brent crude surged above $97 a barrel on Monday after Iran's Tasnim news agency, affiliated with the Revolutionary Guards, reported that Tehran's negotiating team had halted message exchanges with the United States and that allied resistance forces were considering a complete Hormuz blockade. The initial news could not be confirmed, but crude contracts repriced immediately. Brent up 6.6%, WTI up 7.7% in a single session, because the market was not positioned for this scenario at all. Iran's Strait of Hormuz threat arrived as the AI equity rally had pushed major indexes to consecutive record closes. The positioning mismatch between equity valuations near all-time highs and a bond market pricing in emergency rate risk created the day's real tension. The Dow fell 132 points, the S&P 500 ended mixed, and tech stocks absorbed the selling pressure unevenly, a pattern that signals institutional repositioning rather than broad liquidation. The inflation transmission path from this oil shock is already in motion. The Cleveland Fed's inflation nowcasting tool shows a trailing 12-month inflation forecast of 4.18% for May, 178 basis points above the 2.4% reading in February, before U.S. strikes on Iran began. Gas prices have risen at their fastest pace in over 3 decades. Energy cost inflation now has 2 stages: the pump price stage, which is already visible, and the transportation and production cost stage, which takes 6 to 12 months to flow through the economy. The bond market has begun pricing the second stage. Foreign institutional holders, who absorb the largest share of 30-year Treasury supply, shifted positioning aggressively on Friday as Trump suggested patience with Iran was running out. The 30-year yield's move above 5% represents the bond market withdrawing its assumption that the Fed's rate pause is durable. Institutional net selling of long-duration paper accelerated through the session. Retail bond positioning has not yet moved, creating a divergence between institutional and retail duration exposure that typically closes in one direction. New Fed Chair Kevin Warsh has taken office in this precise environment: inflation moving toward a 3-year high, oil above $95, and a Senate confirmation that won 54-45, the narrowest of any Fed chair in modern history. Warsh has a documented hawkish voting record. The Fed funds futures market is pricing rate hike probability at non-trivial levels for January, meaning the floor under equity valuations that a rate cut cycle would have provided is no longer a consensus assumption. The unresolved question is whether the oil price spike is the beginning of a sustained energy shock or a positioning squeeze that partially reverses if diplomatic signals improve. Over May, Brent and WTI had already lost 19% and 17% respectively, the largest monthly declines in absolute terms since March 2020. The current bounce is recovering a fraction of that fall. Goldman Sachs' base case still has Brent at $90 for Q4, which assumes diplomatic progress. If that assumption is wrong, the transmission into inflation and rate expectations has not finished moving.
On the same day that Iran headlines pushed bond yields above 5%, Nvidia's new RTX Spark announcement sent Intel stock down 6% and AMD down 5%, and the S&P 500 closed near records. That combination is the paradox this chapter resolves. Nvidia unveiled RTX Spark, an ARM-based chip for Windows PCs that combines a CPU, GPU, and up to 128 gigabytes of unified memory on a single package. The chip runs the full CUDA software stack, meaning every AI application built for NVIDIA's data center GPUs can run on a Windows laptop without modification. Microsoft, Dell, Asus, Lenovo, HP, MSI, Acer, and Gigabyte all announced systems built around RTX Spark. Microsoft's Surface Laptop Ultra is the flagship device. NVDA moved up approximately 4% on the day. ARM holdings surged over 10%. Hewlett-Packard Enterprise hit a record high on AI server momentum. Intel fell 6%. AMD fell 5% at the open, though it partially recovered to close up 5%, a reversal driven by UBS raising Micron's price target to $1,625 from $535. which generated a read-through bid across the entire memory and semiconductor complex as institutional holders reweighted AI infrastructure exposure. The capital displacement here is specific. Intel and AMD's PC chip businesses, the consumer CPU franchise that has defined both companies for 2 decades, lost a significant portion of their forward revenue assumptions in a single session as institutional sell-side models began adjusting addressable market estimates. The money that exited Intel moved into ARM, whose architecture powers the RTX Spark chip, and whose royalty structure improves with every Nvidia PC unit sold. Passive index flows still hold Intel and AMD. The active institutional exit from those names has not yet propagated into passive redemptions, which creates a lag that may extend the pricing pressure. The Nvidia PC entry also changes how the AI inflation loop works for equity investors. Higher oil prices and a rising rate environment would normally compress semiconductor valuations through a higher discount rate. But Nvidia entering a new $300 billion PC market, one where Intel and Qualcomm had previously set the pricing ceiling, shifts the earnings growth trajectory sharply enough that institutional holders are accepting a higher rate environment as the cost of not missing the Nvidia PC cycle. Jim Cramer described the ARM reaction as the market pricing Nvidia's architecture tax across every Windows device sold. That framing, that Nvidia now collects a structural toll on the PC market the way it does on the data center, is what institutional buyers repriced in a single Monday session. Micron's crossing of a $1 trillion market cap on the same day adds a layer. AI memory demand has consumed nearly all production capacity. Micron's forward revenue guidance of $33.5 billion for the quarter ending May 31, 263% year-over-year growth, is the supply constraint made visible. The AI capital bid that is holding equity indexes near records against the bond market's rate warning is concentrated in this semiconductor basket: Nvidia, ARM, Micron, HPE. The Hormuz oil shock has not yet broken that bid. The question after Monday's session is whether it can.
Strategy sold 32 Bitcoin last week for $2.5 million. The size is trivial, less than 0.004% of its 843,706 BTC holding. The market reaction was not trivial. MSTR fell 6%, Coinbase dropped 5%, Bitcoin fell below $72,000. The gap between the size of the sale and the size of the reaction is the signal. Michael Saylor spent 4 years building the never sell narrative as a structural support for Bitcoin's institutional adoption story. Every time the market tested Bitcoin's floor, Saylor's relentless buying, 843,706 BTC at a cumulative cost of roughly $62 billion, functioned as a visible demand backstop. Institutional Bitcoin holders did not just buy BTC, they bought the assumption that Saylor would always absorb the next drawdown. The sale breaks that assumption at the structural level, not the magnitude level. Strategy's SEC filing shows the proceeds went to fund distributions on its STRC preferred stock, which carries an 11.5% annual yield and has grown to a $10.38 billion market cap. The preferred stock structure requires predictable cash distributions. Bitcoin's price volatility does not provide them reliably. The model has always contained an internal tension between the never sell narrative and the actual cash obligations that the preferred instruments generate, and the sale makes that tension explicit. Bitcoin was already down 32% over the prior year when the filing hit. BTC traded near its all-time high of $125,000 in October. At $72,000, holders who entered between $90,000 and $125,000, the price range that attracted the most institutional accumulation after spot ETF approval, are sitting on unrealized losses. Mark Cuban's simultaneous disclosure that he sold all his Bitcoin, citing gold as the superior inflation hedge precisely at the moment when the Iran oil shock was generating actual inflation, added directional pressure from a different narrative layer. The Polymarket prediction market data provides a positioning map. 63% probability that Strategy announces a fresh Bitcoin purchase between June 2nd and June 8th, and only 5% probability of a margin call in 2026. Retail positioning on MSTR skews defensive, bearish across 6 of 8 sentiment windows on Reddit's Wall Street Bets, with the dominant post advocating puts. The divergence between institutional Polymarket pricing, which still expects net Bitcoin accumulation, and retail positioning, which has turned short, is the unresolved participant structure that the next Strategy filing will resolve.
The Iran shock running simultaneously creates a specific risk factor. If oil stays above $95 and the 30-year yield holds above 5%, the risk appetite that supported Bitcoin's recovery from $40,000 to $125,000 over the prior 2 years, the same appetite that drove AI equity and speculative digital asset allocation in parallel, faces a rate and inflation environment that it has never been tested against at current valuations. Bitcoin below 72,000 with the 30-year yield at 5.1% is the specific condition that has not appeared before in Bitcoin's institutional adoption cycle. Whether the AI bid in equities holds while the speculative bid in crypto contracts is what the next 4 to 6 sessions will price. The verification benchmark is Strategy's next Form 4 filing. If it shows BTC purchases resuming above the $77,135 average sale price, the structural never sell assumption is partially restored. If the next filing shows another sale at any price, the participant structure that priced in permanent sailor demand will need to find a different floor. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.